We asked people around us one simple question: what's the biggest investing mistake you've made? And we were surprised. Almost everyone gave the same answers.
Yeah, I bought क्योंकि वो बहुत famous हो रहा था.
Buying ETF when it was at its all-time high.
Overconfidence.
These are different styles of investors with different portfolio sizes, but their mistakes are the same. So we wrote them all down, looked at them closely, and we bring to you the 10 most real investing mistakes that can eat up your real returns. Stay with me till the end because chances are at least one of these is already happening in your portfolio. And if you find out which, then let us know in the comments. So let us start with mistake number 1. Buying a great business at a bad price. Look at these examples. Paytm is down 83% from its peak. Eternal corrected 73%. Card rate fell over 70%. Did the investors buy bad companies? No. They just overpaid for good ones. At high prices, the market expected everything to go right. And the moment things became normal, the stock fell hard. So the key point for you is returns depend on the price you pay, not just the quality of the company. A great company bought at the wrong price can still turn into a bad investment. Okay, now let's look at mistake number 2. Getting emotionally attached to a stock. Think Nokia, Kodak, Reliance Communications. At one point, these were seen as strong, long-term stocks. People trusted them and held on for years. But what went wrong? They did not collapse overnight, but the technology changed. Industries changed and these companies couldn't keep up. The mistake investors made was holding on because of the past and not looking at what the business was becoming. Here's the simple truth. A stock doesn't care how long you've held it. It is not a lifetime commitment. Markets change, businesses change, and when that happens, your decision has to change. So long-term investing also needs you to buy, track, and reevaluate. Okay, now let's see what the next most common mistake is. Averaging a falling stock. Let me explain this one with the example of Yes Bank. The stock fell from around 400 rupees. At 200 rupees, it looked like a 50% discount. At 100 rupees, it felt even cheaper. At 50, people called it value buying. Basically, at every level, investors found a reason to buy more. And then it kept falling, all the way to single digits. And that's where the mistake happened. When a stock keeps falling, you don't have to buy it just because it looks cheaper. You know what is this called in market terms? Catching a falling knife. Here's the key thing investors miss. A stock can fall 70 to 80% and still have room to fall more. In Yes Bank's case, the fall wasn't because of the market. It was because of serious business and balance sheet issues, and those don't get fixed quickly. In fact, there were small rallies in between which gave investors hope, but the overall direction stayed down. So remember this simple rule. Not every fall is an opportunity. Sometimes it's a warning. Okay, now let's move on to the next common mistake. Investing by comparison. This one happens more often than we actually admit. Your friend invests in a risky stock and makes 50% returns, while you are invested in a simple index fund and let's say make 8 to 10% returns. Suddenly, your perfectly sensible returns feel wrong. And you start thinking, maybe I should do what he's doing. And that's where the problem begins. The problem is not that he made more money. The problem is you are assuming you can take the same risk, handle the same volatility, and sit through the same drawdowns. Remember, every investor has a different risk capacity, different income stability, and very different emotional tolerance. What suits someone else's portfolio can be completely wrong for yours. Repeat after me, your friends' returns are not your benchmark. Okay, now let's move on to the next most common mistake, not diversifying enough. Well, this one usually starts with confidence. You like a sector, let's say IT, so you put a big chunk of your money into IT leaders like TCS and Infosys. They are large companies, they feel safe. The thinking is, what can go wrong here? But then sentiment changes. News comes around AI disruption. And suddenly people start questioning the future demand for IT services. And within days, about 2.5 lakh crore of value gets wiped out from IT stocks. TCS is down nearly 15% this year. Infosys is down around 12 to 13%. Now, if 50 to 60% of your portfolio was in IT, how would that feel? Did these companies suddenly become useless? No. What changed was how the market felt about the sector. And when most of your money is in one place, that change hits your portfolio very hard. So the simple takeaway here is if all your money depends on one sector, one bad phase can shake your entire portfolio. So diversify so that your risk is balanced. Alright, now let's move on to the next one, which is overconfidence. This one usually shows up after things go well. You make money in a few trades, one stock works, then another, and then suddenly you feel comfortable. And that's when small things change. You trade more often, you take slightly bigger bets, you stop asking what can go wrong. Basically, the discipline that gave you returns quietly disappears. And nothing breaks suddenly, which is exactly why this mistake is even more dangerous. The simple rule to remember here is one good phase doesn't make you smart, it just means the market was kind. So respect that and stick to the process always. Okay, now let's look at the next common mistake, which is timing the market. This sounds simple, but hear me out. I'll buy when the market falls, I'll sell when it goes higher. Everyone thinks this way. But here's what usually happens. The market falls a little, you wait for more. The market rises a little and you wait for a better price. And while you're waiting, the market moves on without you. And you know the damage here? Most investors don't lose money because they bought at the wrong time. They lose money because they stayed out for too long. And the funny part is, the biggest market gains often come right after panic. And if you're sitting on the sidelines, you miss them. So remember this, you don't need perfect timing, you need time in the market. Let that sink. Okay, now let's move on to the next most common mistake, which is information overload. This is something which everyone complained about. Information is not the problem today, there is just too much of it, which is the problem. News channels, Twitter, WhatsApp forwards, whatnot. Everyone has an opinion and you consume all of it. You plan to buy today and tomorrow a new news item comes in. Then another opinion and suddenly you do nothing. This is what happens to many of us. You either keep waiting or you act under pressure. Both hurt your returns. Markets will always create noise every day. The simple rule is this. Not every piece of information deserves your attention. Good investing is not about reacting to every headline. It's about focusing on what actually matters and ignoring the rest. Alright, now let's move on to the next one, which is greed. Sounds like suddenly we are in a moral values class, but this is a very repeatable mistake most of us fall for. And I have a recent example for this one. Silver. It was rallying hard. Prices kept going up, momentum looked unstoppable and people didn't want to miss out, so they kept buying higher and higher. Some people we interviewed even used leverage. But then the momentum slowed and prices corrected. And suddenly holdings were down close to 45 to 46% from the top. The problem was buying late, which was driven by greed. This is how greed works, you know. When prices are rising, risk feels invisible and upside feels guaranteed. That's when investors stop thinking about protection and start thinking only about returns. So remember this, fast money stories usually end fast. Real wealth is built slowly with control. Okay, now let's move on to the last and most common and actually the most silent one. Inaction and ignorance. You invest the money and then you move on with life. No review, no rebalancing, and then years pass. And meanwhile, your portfolio changes without you noticing. One stock becomes too big, one sector quietly dominates, risk slowly increases, and nothing feels urgent or wrong, and that's the danger. There's another layer to this, tax planning. Every year you get exemptions. If you don't use them, you lose them. And that loss compounds year after year. Many investors don't lose money because they made a bad call, they lose money because they stopped paying attention. So simple rule to remember here is long-term investing does not mean set and forget. It means invest and review repeatedly. So these were the 10 most common investing mistakes. Not theory, not gyan. These came straight from real investors, real portfolios and real regret. The goal isn't to be perfect, it is to catch these mistakes early on. Now tell me in the comments which one felt the most familiar to you. If this video made you pause before your next decision, it has already done its job. Like it, share it with someone who's investing seriously, and I'll see you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.